This has never been about changing the world with technology. This has always been about liquidity. And there's wonderful narratives that can go along when you have these big rallies up, and then, wonderful narratives on the way down when you're fighting the world. But the reality is that you have to know the source of your returns.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Larsen.
For me, the best part of my podcasting journey has been the opportunity to speak to a huge range of extraordinary investors from all around the world. In this series, I have invited one of them, namely Alan Dunn, to host a series of in-depth conversations on the topic of what it takes to be a world-class allocator. In today's world, portfolio construction is fast moving to the top of the agenda of many investors as they try to analyze and understand the riskiness of their portfolios. And with ever-increasing uncertainty around the globe, being well diversified across many different strategies and themes in your portfolio can mean the difference between ruin and survival when the next crisis emerge. The aim of these conversations is to try and understand the experiences that have influenced these highly specialized allocators and the processes they follow to harness the best returns for their clients so that we can all become better informed investors. And with that, please welcome Alan Dunn.
Thanks very much for the introduction, Niels. Today, I'm delighted to be joined by Cameron Dawson. Cameron is Chief Investment Officer with NewEdge Wealth in Connecticut, United States. NewEdge Wealth is a $8 billion RIA serving high net worth, ultra high net worth and family office investors. Prior to joining NewEdge, Cameron was Chief Market Strategist at Field Point Private. We're delighted to have Cameron with us. She's a frequent speaker on the road these days, particularly on CNBC, I think. I heard her yesterday. Cameron, great to see you today. How is everything in Stamford, Connecticut?
Oh, it's good. It's a muggy day here in August, but very happy to be here with you.
Good stuff. Well, we normally start the conversation just to frame things a little bit by getting our guests to talk a little bit about their background and how they ended up in the investment industry and their route to their current role. So could you give us a bit of a background on yourself?
Sure, I probably have one of the least orthodox ways of finding my way into investments, because at the ripe age of 15, I decided to quit normal high school and become a full-time ballet dancer and homeschool myself online. Got injured, then said, I guess I should probably go to school, found my way into economics, loved it, stayed and did business school because when I graduated, it was in the midst of the great financial crisis. And so I was lucky enough that the business school was offering scholarships based on GMAT scores. And so I stayed and once I got into business school said, I'm kind of bored with all these soft skills. What's the hardest thing I can take? And somebody said security analysis and portfolio management. I took it. I was hooked and said, I have to do this. I didn't have a lick of finance experience and didn't have any connections. Was very fortunate that the alumni network at my school, I went to Rollins, kind of opened things up to me. And I actually found my way into Bank of America, my first job in the industry, through the CFA Society of Orlando. Applied for a scholarship and they got me in. And that was 10, 11 years ago now. And spent 2 years at Bank of America working in high net worth private wealth management as an analyst for them. And then moved up and I was the lead industrials analyst for the buy side at B of A in our chief investment office for 6 years, so a total of 8 years at B of A. Then moved over to Field Point to broaden out and become more of a generalist market strategist, and that lends itself very well to the industrials background. I know we're not on video today, but I have a cat hat on because industrials will always be in my blood. Very cyclical sector that is, it teaches you a lot about very quick cycles in the marketplace. So. Then that market strategy view led itself into stepping into the CIO role, which has just been absolutely extraordinary at NewEdge. It's such an exciting company with great people, and so I'm thrilled to have been there for about 4 months now.
Good stuff, and obviously it's focused on the wealth management sector, I guess. Could you give us a sense on, I suppose, the types of portfolios you run? I guess it's a long-term focus, possibly multi-generational wealth. Any kind of constraints or anything unusual about how you have to manage the portfolios for this particular segment of the investment industry?
Sure. Well, I think that this market within investments, it matters actually less what index returns are, and it matters more what you keep at the end of the day. So that does create some constraints and also some different avenues when we think about our investments. For example, taxes are really important to our investors. These are individual investors that are usually in the highest tax bracket. So where you might want to make certain decisions on a short-term basis because you have high conviction in the performance of one asset class or another, you may not make that decision on an after-tax basis. But it also means that when we think about asset allocation, we're also thinking about asset location as well, making sure that the right assets are being held in the right places. And it also means that we have a very long-term view of things, meaning that if we are thinking about multi-generational wealth or money that people might not tap into for many decades, the end result is you're going to invest it very differently than if you were just trying to maximize 6-month returns. And it also leads into our investment process a lot because we have to think about after tax, after fee returns, and we're very sensitive to that and find that that after tax, after fee alpha can be just as important as your traditional investment alpha, mostly if you're doing it right. So we have to take a very broad approach and probably an integrated approach with wealth strategy as well, meaning that investments in wealth strategy can't exist on their own, and it's a very robust way of looking at the world, but it's what's needed for these high net worth, ultra high net worth clients.
Very good. You touched on how excited you are to be stepping into the CIO role at this point in time, and I guess it is both fascinating, exciting, and challenging. It's been a year so far where bonds and equities have been down, so it's probably the most interesting macro environment we've had for a number of years. I guess starting from that perspective, inflation's been probably the buzzword in the markets for the last 12 months or so, if not longer. When you're thinking about portfolios and asset allocation, how has this tough environment with unexpectedly high inflation and a difficult environment for traditional assets, how have you been navigating that for your clients?
Yeah, well, the first point of the market volatility is the reason why I didn't get a vacation in between gigs. So okay. I ended one job on a Friday and I said, these markets are too interesting. I'm going to start right on Monday because it's one of the most fascinating times that we've been in, to see the worst start of a year for the bond market ever on record to start this year. At the same time, you've had a fairly rapid and pronounced equity rout that is even more pronounced depending on which index you look at within the U.S., what type of asset. Certainly investors that thought that they were going to get some kind of diversification from their standard 60-40 portfolio didn't experience that at all this year. And the question is, where do you go from here? And I think back to when inflation really first started kicking into high gear it was really April of 2021. That's the first month that we had when inflation on the CPI basis went significantly above it. It hit about 4% that month, above the Fed's 2% target. And what's really interesting is that if you had called the inflation right and said, we're going to have runaway inflation for X, Y, and Z reasons, and here's how I'm going to structure my portfolio. I'm going to go short long bonds, meaning that I think that long bonds are going to get hit pretty hard because yields have to rise. I'm going to go long gold. I'll go long other kind of maybe digital gold like a Bitcoin or something as an inflation hedge. You were really wrong for the first 9 months of that inflation experience. And assets did not behave in the way that I think people expected them to. And I think this gets back to what the real drivers of portfolio returns are, and that we have had so few true really high inflation experiences to extrapolate the short period of time from for example, from the 70s into today and expect asset returns to be similar, I think is misleading. One of the big differences to get a bit more granular, I think, is the dollar. So if we go back to the 70s, we had a rapid 30% depreciation of the dollar in the early 70s as Nixon took us off the gold standard. And that certainly fed into the inflationary experience that the U.S. had at that time. And actually, it's a little bit more akin to what Europe is experiencing now, this dual-headed monster of both a currency crisis as well as an energy crisis. But that weak dollar has been something that's defied expectations this year. Or really all through 2021. A lot of people were calling for the dollar to be very weak in early 2021 because of twin deficits, and that simply did not happen. The dollar was really strong for a few reasons. The Fed was still very easy, but I guess it was somewhat less easy than the ECB and the BOJ. But dollar positioning had also gotten really short in early 2021. And so as we saw the dollar strengthen all that year, what it did is it kind of put downward pressure on things like gold prices that you would have expected to do well in an inflationary environment. You also have to consider things like real yields for gold as well. But I think that what we get back to, and to get to the gist of your question, is how do you position portfolios in this high inflation world? And we don't have that many parallels, like I said, to extrapolate from. And I think that those averages of saying, oh, well, this is what assets did in high inflation can be very misleading, because we never have an average experience. So my preference is to maintain portfolios that are very balanced and put in some kind of hedges in areas that are that I think can benefit from an inflation experience. So a simple example is we've kept our overweight to energy all this year. And even through the route that we had in the summer months, where energy stocks sold off by like 25% in a very short period of time. But at that point, we decided to keep the overweight for the simple reason that it is a hedge on the portfolio in the event that oil prices kick back into high gear again if they were to start moving much higher. And it's a cheap way to get that hedge. It's trading at a little over 7 times earnings. So let's say that for some unforeseen reason, oil prices start skyrocketing, and instead of gasoline being on a continued downtrend as it has been since mid-June of this year, like 75 days consecutively, if that starts to move in the other direction, we would expect it to be really bad for other parts of our portfolios. But at least we have this balance and this exposure to energy that can help offset some of those headwinds that you could amount if we do see energy prices actually move higher. And as I said, we're not paying a lot for that kind of hedge because we're getting it for a very cheap valuation. At the same time, that expectations have been pulled in quite a bit since the big rout that we've had.
Good stuff. So obviously you're thinking with energy there in terms of kind of sectoral tilts, I guess, within the asset allocation. And then from an asset allocation perspective, how active is the asset allocation approach? Do you kind of go radically underweight equities or bonds, or is it, as you say, a reasonably balanced approach with kind of tactical tilts overlaid, or I guess overall kind of what's the investment philosophy that underpins the whole asset allocation process?
Yeah, it gets back to the first answer of that we discussed, which is that taxes are important for our investors. So as much as we would love to do this like max underweight when we thought markets would be really weak, we have to consider that capital gains taxes are a significant drag on portfolio returns. And so what we start with is we start building a portfolio from the core out. And the core of the portfolio are the parts of the portfolio that you don't have to touch very much, with the idea meaning that I want names that have really good downside capture, names that are somewhat defensive in a downturn. Not your prototypical classical defensive names, but those that, like saying, oh, I'm only going to own utilities or staples. Those tend to have more episodic volatility to the upside, meaning that they only have periods of outperformance when everybody is way too scared. We prefer instead a much broader approach, which is quality, meaning that we'll build this core of quality. And the whole power behind quality is that when you own those names, and obviously we're looking at these on a constant basis to make sure that they remain high quality, but they shouldn't retrace all of their gains from the last upcycle. Because that's what kills returns, is that, yes, you can have this big, huge up movement, big, huge up cycle, but if you have to sell at the top, pay a lot of cap gains, and or retrace all of your prior gains, that's a problem. So we call them core compounders because the idea is that, yeah, we're going to have volatility through cycles, but if we own these core parts of our names, core parts of our portfolio and names that are high quality, we can ride out those cycles and not have to tinker with it very much. And then what you can start building from that core is that's really the growth part of your portfolio. That's the long-term view of your portfolio. You want to hit a certain return target over the very long run on an after-tax, after-fee basis. And then we can be a bit more opportunistic with our tactical tilts on the outside. There's going to be times when beta, low quality, performs really well. We've been in a 2-month period where that was the case. You can layer in beta to that outside. Maybe you have higher income needs, and we can layer in income as well, kind of to complement that core. And then it comes in the question of where do you go outside for two other kind of important considerations for investors. The first one is low correlation, and the second one's return enhancement. And that's when we have to be very well integrated into the wealth strategy, because if a client has a very long-term view, a very long-term need for the assets, having low correlation isn't necessarily that valuable to them. And low correlation really is only valuable in a liquidity context, meaning that if something has low correlation, the whole idea behind it is it helps dent portfolio volatility without having to give up so much on the return front. But if you have a liquidity event, say something happens and you need that money, and then you can't sell the things that are doing well, then that low correlation actually really hasn't done much for you. Mostly if you have to sell assets that have been beaten up and are trading, at lows, and that's how you do the reverse of compounding through cycles. So we think about this risk budgeting in these low correlation assets. So your traditional kind of hedge fund assets, we can talk about private equity venture a little bit differently. That's kind of phantom correlation, just because of there's some parts of it that are not correlated, but the broad asset classes tend to track mostly as they've matured traditional public market returns, maybe with a little bit of an illiquidity premium. So once you've identified your need for low correlation based on the liquidity needs of the portfolio, then you can pivot to return enhancement. And that's where we look for private equity, venture capital, some hedge fund options in order to provide return enhancement, mostly because we see ourselves in a lower return world in public markets based on equity valuations, equity positioning, and where yields are today. And in that return enhancement, our ethos, and one of the things we think makes us powerful, is that we sit in a sweet spot of size as a firm, meaning that we are small enough that we can look at deals and funds that are more niche and have we think a better probability of alpha and outsized returns versus big mega funds, which the whole idea is that over time, alphas decay into betas, meaning that your alpha, your market outperformance over time gets whittled away and just ends up looking like beta or the market return over time. And we think that that's what's been happening to a lot of these bigger funds. So it's our preference to look at small funds that our large competitors would never be able to look at, A, because it wouldn't be worth their time, and B, because they would just eat up the liquidity of it too quickly. If you're with a large fund or a large firm allocating $2 trillion of client assets, you're not going to look at $100 million or a $200 million fund. But we'll look at it all day long. And that doesn't mean that we're going with sub-tier players. We're going with big established players, but we're preferring to play on the smaller side of funds. There are bigger funds that we participate in, but the stuff that gets us really excited is that differentiated niche things. And that's where we think we actually can deliver on that enhanced return part of portfolios.
Okay, interesting. So it sounds like a focus on quality in the core, but at the same time, in traditional assets, an environment that looks a bit more challenging than maybe we've seen going back a few years, given this kind of low return environment. When you think about the portfolios from kind of a risk management perspective, and you touched on the 1970s, and which was, and you're saying obviously it's not exactly the same this time, there are parallels, but slightly different. But if we were to go into a very different macro environment for the next 10 years, and you had obviously maybe surprisingly high inflation on a consistent basis, and a lost decade for equities like we had maybe in the 2000s, and I guess in real terms it was the same in the 70s. Do you have kind of do you think that the quality can kind of overcome that kind of environment, or do you look to those return enhancements kind of strategies as the thing that would take the portfolios through in that type of environment?
Yeah, I think, well, the first step is expectation setting. And I think that's something that we have to do as advisors or investment managers, is to expectation set and to really be clear that starting points matter. When your bull market in equities in 2010 or 2009 kicks off and you're trading at 12 times earnings, allocations to stocks are at near record lows. If you look at measures like AAII indices, equity market cap as a percentage of GDP is very low. You look at overall sentiment being washed out. People have just given up on the asset class overall. That's how you deliver. That starting point is how you get 10 years of returns that were more than double the long run average. And so now we're in an environment that's the exact reverse. Valuations are high. Allocations to stocks have on an institutional basis are light right now, but if we look from a household basis, which tends to be more impactful for forward returns, those still remain very elevated. They've come off their highs in this latest route, but certainly they remain elevated, not like they were back in 2008 and 2009. And so what that speaks to is you're going to, like, if these relationships hold, it kind of get average at best, which means that instead of 14% compounded on a 10-year basis, you're looking at 7 to 8% in a best case scenario. Then the next step of that, and this gets to your point about the 70s, which is that how do you actually get to that 7 to 8%? Because there's a lot of ways to get to average, meaning that you could have a big market crash for the first 2 years and then make up for it as you go on in the later years. You could have a big, huge equity bubble bull market run and then a crash that causes you to have those average returns. Or you could be like you were in the 70s, where you were essentially flatlined from 1968 until 1982, and you just oscillated around a wide band. And each of those scenarios, that's why it's important to not get too married to these long-term perspectives about low returns and to stay tactical and nimble, because how you invest is very different based on each of those scenarios. Let's take the last one though, because I think that that's actually really interesting, because if we're in a world where we think we could be oscillating around some directionless band, it necessitates a few things. It necessitates active management. And active management, not just from security selection, which I'll get to in a second, but also in kind of overall allocations. You might want a little bit more of a buy low, sell high approach to those bands, meaning that, once you kind of have rules that, outside of if you're thinking you're somewhat sideways, that you trim equities after, at certain levels and you buy at other levels, that maybe that can be helpful. Again, that introduces the need to be very tax efficient though, because compare that to the last world we were in, where you could just throw everything into SPY and close your eyes. And at the end of 10 years, you had 14% compounded returns. But the other part that you're asking about, which I think is really fascinating, which is where we have to be very careful about quality investing in that core investing, which is the lessons that we learned from the Nifty 50. And the Nifty 50 was this group of stocks that stole the hearts and minds of investors in the late 60s. And Professor Jeremy Siegel is the one who did the seminal work on these names. And essentially, these were the stocks that you could buy today and hold forever because they were the best names out there. They were new technology. They were exciting. And everything from IBM to 3M to Kodak, which when you look back at that time, the conclusion that Professor Siegel came to is that, these stocks that were supposed to be the great, amazing, future stocks, they had become so overvalued that even though they delivered better earnings growth through the next decade, they had much lower returns because you were already pricing in all of that benefit into the current years. And so we have to be careful about valuations when we're thinking about quality and core, because a lot of things that might screen as very good quality, if you don't have valuation discipline, it can all work against you. And it's a great lesson for investors in thinking about growth anyway, which is that if you price the world of growth into today's valuation, even when that growth materializes, you don't get any benefit from it because you've already given the company credit. And not to get into an individual name, but I think we can see this with Zoom that reported last night. I was looking at some of the numbers, and it's such an important lesson for investors. At its peak in 2020, Zoom was trading at 70 times sales. 70 times sales, and its market cap was $170 billion. And it was obviously pricing in a huge period of revenue growth because of all of these shifts and changes happening. And guess what? They got it. Revenues are now 6 times higher today than they were pre-pandemic. But the stock is down materially. That $170 billion market cap is now less than $30 billion, and it's trading at 6.5 times sales. And so valuation, though it's not helpful in the short run, Valuations can go high and stay high. They can go low and stay low. They are so important for long-run investors to get to be able to forecast long-run returns. And so, they're not a great timing tool, and they can't help you make a decision necessarily today, mostly on an aggregate basis. But we look at them very closely and study them a great deal because they have so much impact on what your forward return experience will be.
Interesting. Well, you touch on a few themes there that I think are really interesting. One, as you say, we talked about the 1970s, and as you rightly point out, we had these oscillations, for the markets. And I think that's one of the things that strikes me. You say in the 1970s to people, and as I said, tough decade for equities, but obviously that forgets the point that within that whole period we had some big rallies, and probably three or four, at least three significant down moves in the equities. So tactical is important. And then secondly, from a valuation perspective, I think you raised an interesting point there as well, because obviously you talk about Nifty 50, and I guess we had the same phenomenon back in 2000. People talked about stocks that you had to own back then as well. And again, in 2020, 2021, stocks, people talked about the FANG stocks as kind of bond replacements, because the certainty of earnings was the argument. So it is interesting that we have these recurring cycles, and as you say, valuations matter. And I guess when you think about valuation, that's probably maybe where the macro can meet the micro to an extent. If you think about, you've got the earnings side and the multiple side, and obviously the multiples are going to be heavily influenced by the discount rate. So again, how do you, as a strategist, as a CIO, get comfortable? A lot of people saying now, well, if we went into a different macro environment, margins could come down a lot, wages could be a lot higher, the E side of things might be under pressure, and then obviously what we've had in the markets over the last couple of years is the discount rate has jumped up. 10-year yields have gone from 0.5% up to say 2.5%, 3.5%. So if that, again, from a valuation perspective, what's the right rate on that side? So you've got a lot of moving parts. It's one thing to say valuations are discipline around valuation, but how do you get comfort that you're, I guess, building in enough of a margin of error given that really uncertain macro environment?
Yeah, it's such a good question, and I'm going to be dangerously reductive here, if I can. So, in a very simple way, I think that you have to get the macro manufacturing, employment, consumption cycle to forecast earnings. But then you have to get the liquidity cycle to forecast valuations, meaning that valuations are sometimes in response to what the earnings picture is, and can talk about when that happens. But overall, valuations are really driven by liquidity, meaning that when liquidity is becoming more abundant and accelerating higher, and you can crudely measure this by looking at money supply growth. There's far better measures by some of the sell-side research shops on the street where they measure excess liquidity in the environment. So essentially, how much liquidity do you have in excess of what's really needed for underlying growth? And when you have lots of excess liquidity and that excess liquidity is becoming even greater, that supports higher valuations. Now, the inverse is true, meaning that when liquidity is getting tighter, that supports lower valuations. And I think that this is true in the world of quantitative easing in the post-Great Financial Crisis world, because you can see it much more clearly during those times, which is that if you looked at the periods of multiple compression that we had from 2010 until 2000 and let's call it end of 2020, each of those periods of multiple compression, which were weak markets, were periods that coincided with the Fed either not providing as much market support as the market wanted, such as in 2010, 2011. We had a gap there between QE rounds that coincided with the issues around the European debt crisis, which led to weak markets and a lot of multiple compression. You had the 2014 through early 2016 period, which was taper tantrum into the balance sheet. Or we had taper tantrum, then the actual taper, and then the start of interest rate hikes in late 2015, which caused a lot of multiple compression. Then you had the 2018 period, which had quantitative tightening as well as interest rate hikes, multiple compression. And so what is kind of confounding to people sometimes is how you can see stocks be so strong when earnings are so weak. And the great example of that is 2019. 2019 was actually a pretty tough year from an earnings standpoint. You saw earnings decelerate materially. You saw issues with margins. You saw the PMI decelerate quite significantly, the Manufacturing Purchasing Managers Index. Yet stocks had a gangbusters year. And the reason they had a gangbusters year is because, positioning was light. You had that swoon in late 2018. But because liquidity was becoming more abundant. You saw money supply growth actually reaccelerate in late 2018. And then what happened is you saw the Fed actually cut interest rates. And through that time, money supply growth started reaccelerating. And so to get it back to this main point, you can forecast earnings perfectly. But if you ignore the liquidity cycle, if you ignore the path of the Fed, you can get the multiple wrong and thus get the stocks wildly wrong. And so I think that we have to balance those two things where, what ends up happening is you go, okay, I can have a pretty dire outlook on earnings, but if I think the Fed's going to come in and save the day, I need to put that earnings outlook to the side because the multiple trounces earnings any day. Now, we've been in a world where multiple compression is what needs to happen because liquidity is getting tighter. And it's been one of the reasons why we were doubtful about this very recent rally, because what we saw is multiples expand materially. They went up 20% off of the June lows. And yet there were really no indications that liquidity was going to start becoming more abundant, meaning that the Fed wasn't really sending any signals that they would like to see money supply growth reaccelerate, which meant that this multiple expansion that we got really wasn't founded on anything but just a positioning kind of recalibration. And to kind of tie a bow on it, I think there's only 3 reasons why you should pay more than 20 times for earnings on stocks. And maybe we can talk that maybe that's a 21 times because of the changing in the constitution of the S&P 500, more tech names, higher quality companies, better cash flow, better return on invested capital. Fair and fine. But let's say it's 20, 21 times. The 3 reasons. The first one is if earnings are so bad that you pay a high multiple for today's earnings because they're going to grow a lot. That's partially what happened in 2020. 2019, 2020, but really 2020, you collapse earnings so you can pay a high multiple from it. Not to bring the cat hat back into the story, but cyclical stocks, they trade with their multiples are always inverse of their earnings, meaning that you put the lowest multiple on the highest earnings at the peak of the cycle because earnings are going to decelerate, but then you put the highest multiple on the lowest earnings because they're about to really take off and accelerate to the upside. So you can pay a lot for earnings if earnings are really depressed. And the true holy grail is when earnings are depressed and valuations are low. And that's what makes returns so powerful coming out of a recession. Everybody's scared, so they're putting low valuations on things at the same time that earnings are depressed. So the second reason why you would pay a lot more than 20 times is because of Fed liquidity. If the Fed is flooding the zone with liquidity, you can pay a lot for those earnings because you have all that excess liquidity. It's accelerating. Now that can be ephemeral because as the Fed giveth, they can taketh away. So you have to be aware that multiples can then compress. But if you have the scenario like you had in 2021, where the money supply growth started decelerating and you saw multiples start falling, but if your earnings were so compressed from 2020 as they were, we had 50% earnings growth in 2021. That offset a lot of multiple compression, which is why we could have such powerful returns in 2021 when everybody thought it might be, including myself, be a much more muted year. So you can't underestimate how much earnings can then offset that multiple if you really are coming out of a depressed period. The last and final point, I know this is long-winded, but the last and final reason why you would pay more than 20 times is if you're in a bubble. And the funny thing about bubbles is that the best returns happen once you've identified that you're in a bubble, right? Like it's sort of like if you can't beat them, join them. But it's a pretty dangerous game to play because what happens on the other side of bubbles is crashes, meaning that you can see these big surges higher and multiples that stay very elevated for a long period of time. But you know that on the other side of that could come a great deal of pain. And this this whole discussion of earnings and multiples and everything is the other reason why talking about that pathway to lower forward returns is so important, because your return experience during that time, whether you have a crash to start or a bubble to start or just flat returns overall, that's when you have to be aware of the earnings cycle from the macro standpoint and the liquidity cycle for the valuation.
So just thinking about that, maybe, I mean, obviously, people in the markets tend to be very focused on the liquidity cycle on a kind of 1, 2, 3 month time horizon from those tactical tilts. But I mean, even looking at it over the next 1 to 2 years, we've already been in the midst of a tightening cycle that's probably surprised people. Obviously, 75 basis point rate hikes. Nobody was talking about those a year ago. So that's fair to say. How do you see that side of things playing out over the next kind of couple of years? Are you, would you have confidence that inflation will come back under control and things will be all okay again? Or what are your thoughts?
Yeah, it's funny. Nobody was expecting these 75 basis points hike, including myself. I remember I was speaking with a friend named Kenny Polcari over the summer, and we were prepping for a podcast. And he's like, "The Fed's going to raise rates rapidly in 2022." And I was like, "No, Kenny, you're wrong. Like you don't know." And lo and behold, here we are. And one of the reasons the reason is that the yield curve was already so flat at the end of 2021, meaning that, how much wiggle room did the Fed actually have before they caused greater economic pain? And what became apparent is that this wild card of the energy issue that showed up, certainly, from the Ukraine crisis, certainly caused a kind of an added uptick in the inflation. But I don't think that we can lay it all on the energy market, because at the end of the day, we're now at oil prices that are back to pre-Ukraine invasion levels. So, how much are we really seeing today's inflation forces being the result of just that kind of black swan event? And I think, to get to the point of the people who did expect the Fed to raise rates really quickly last year, and they were very prescient, is that, and we had been talking about this, which is that, housing prices were going to be the big issue. You'll like this. I during the Euros last year, I wrote a paper called "It's Coming Home Prices," which my UK friends said curse the England team from from not taking home the euros. I'm sorry about that. But this notion that we were starting to see some of these really sticky drivers of inflation take off and move to levels that were far higher than what we had been seeing really for the last 2-3 decades. And so what's happened is that you've had this small pocket of inflation drivers that were one-offs related to the pandemic. And for various reasons, they have metastasized to the rest of the economy. And now you have wage growth that's running at 6.7% using the Atlanta Fed wage tracker. You have housing components within the CPI running at 5.7%. You have sticky components of inflation, meaning those components that tend to go high and stay high. They don't move around very much, running at 40-year highs. You have the trimmed mean CPI, which essentially takes the overall readings of all the components of the CPI and throws out extreme readings on the top end and the bottom end in order to get a sense of so you're not skewed by a few outliers. And it kind of measures inflation breadth, meaning that if your inflation's very high in that trimmed mean, it's not just being pulled up by one or two one-off items. All of these things are at 30, 40-year highs, which really speaks to the challenge the Fed is going to have to really get inflation back down to their 2% target, because you have these very elevated factors. Now, there's been a lot of people coming out over the last few months saying, yes, well, there are parts that are transitory. And that is very true. And probably the most transitory of all the prices is in the durable goods side of things. Durable goods had this dual storm where you had supply chains severely disrupted by the pandemic at the same time that you had demand surge to levels that were out of any economic projection. And the end result was that you had durable goods prices and demand get pulled forward into 2020 and 2021. And they hit a peak, those prices running at almost 20% year over year at the beginning of this year. That's already started to moderate. It's now, if you look at the durable goods components of the CPI, it's now about 8%. And it's likely that they go back into deflation. Essentially, you look at these big purchases, cars, grills, furniture, that type thing that's durable goods related. It's likely that those prices, given the fact that there has been so much pull forward, sees much lower inflation. But again, that's a smaller portion of the CPI. So even if we start seeing those things roll over, you have this services kind of stickiness at the same time of housing issue stickiness. And housing prices lag housing activity data by 6 to 12 months. But then the housing components of the CPI lag the housing prices by 12 months. So though you are seeing weaker housing activity today, we could be talking about 18 to 24 months before it shows up in the CPI data. Now, if it's clear that you're starting to see a lot of deflation in things like rent, for example, which we are not seeing at all, but if it's somewhat clear, maybe the Fed can call victory once we're on a path that we start seeing it moderate. But we are so far away from seeing an inflection point in those sticky factors that's why I find it really difficult to imagine that the Fed would be eager to cut rates in March of 2023 unless we had an incredible liquidity crisis that caused a great deal of economic weakness and a spike in unemployment. But if we have this kind of softish landing, I mean, you look at the PMI numbers today, it doesn't look all that soft.
I guess that's the thing. I mean, what would soft look like? Or I mean, what's acceptable in terms of an increase in unemployment? Is it? I think Powell alluded to some Fed research. Was it that they thought Nauru might have been 5.5%, although nobody knows, and then it might have to go above there. So if you're going from 3.5% to 6.5%, say, is a 3% rise in unemployment. Is that acceptable? Do you think they would continue to hold rates in the face of that kind of a recession, do you think?
Yeah, I mean, probably if you went from 3 to 6, they would want to cut rates. I mean, if we go back to the 2015, 2016 scenario, it's probably one economic episode that should be talked about more. Because I was on the front lines of it, covering the industrial side of things, where we were dealing with the fallout in the energy crisis. But we got pretty close to having a deeper recession at that time, and that's because we had a lot of incremental employment growth from the energy related parts of the economy, and a lot of manufacturing growth from it. And what happened is that all ground to a halt starting in the summer of 2014, when the dollar started to take off quite materially, when the Fed actually started tapering its balance sheet. The dollar took off because the Fed was being tighter than the ECB and the BOJ, who were still doubling down on easing. But that ended up being a fairly soft landing because you didn't see it bleed out into the broader economy. And we were all sitting there, kind of from the cyclical perspective going, oh my gosh, the world is ending. I mean, my companies thought the world was ending, and that it was just a matter of time before everything looked like 2008, 2009 again, because it was that bad. But it didn't bleed out. Consumption stayed fine. And it's a question of, would it have bled out to the rest of the economy if the Fed had continued to tighten policy? They hiked rates once in late 2015. And then when Yellen came out in February of 16 and said, oh, wait, okay, we're not going to hike rates 3 times. We believe you guys. The market's pretty bad and it can't tolerate this. Then everything started to recover. Sentiment got better and you started seeing activity again. It took a couple months for companies to start feeling better about things. But, that was kind of the soft, it was a softish landing. But the only reason why the Fed was able to pivot at that point is because inflation was non-existent. So you have this scenario where if the Fed, and we've been thinking about this a lot, which is that the Fed has to ask itself and address the question of how much of this inflation is their fault. Because the answer to that question tells you how willing they will be to cut rates in the face of weaker growth. If the Fed thinks that inflation is not their fault and that they didn't contribute to the upside surprise that we saw in inflation, then if they see unemployment go to 5%, 6%, then yeah, they probably will become much more accommodative because of the weakness you're seeing in the economic growth. But if they think that inflation is their fault, they're going to be concerned of repeating the sins of Arthur Burns, which is you hike rates in the face of high inflation in 1974. And then you see growth sputter, unemployment ticks up, so you cut rates. But then inflation comes back and it rears its ugly head and you hike rates again, and then you have to cut rates. And it was that stop-go policy and it was all over the place. And what ended up happening is you cemented a decade of inflation. And so if the Fed is concerned that they will be contributing to inflation if they cut rates, let's say sometime next year because growth is weaker, then they might be a lot less willing to actually deliver on that easing. And I think we have to be, we have to listen very closely to Jackson Hole to get a sense of how much culpability they think that they have had in this whole inflationary episode.
Very good. You touched on, return enhancers has been part of the philosophy, and you also mentioned, the importance of active management, and particularly in this current environment where we might have this kind of broad trading range and much more tactical opportunities. And obviously that's part of your remit as CIO in terms of those tactical tilts. But I know you also look at external managers from the perspective of, return generation, etc. I mean, what's your process for thinking about the opportunities when you go to look at external managers? Is that driven by a bottom-up kind of philosophy of just looking for the best managers, interesting ideas, or is there a top-down perspective of, okay, we'd like to have some allocation to these types of strategies, and let's us find the best managers, or is it a bit of both?
I think it has to be both. Your bottom up is really to check the boxes on process and people, because that really gets you to the point of consistency. Because you can do all the top-down work that you want to do, but if they are fair weather managers, meaning they just sort of go with the tides and change their strategy very quickly, then it's harder to pinpoint exactly how you think that manager will perform in the market environment that you expect. So the bottom up is really important to understand processes and kind of checking all the boxes from a management perspective. And then the top down gets really interesting, which is that it's a know what you own and know why things perform the way that they do. And that's where we look at a lot of factor analysis, because I think there were good lessons back in 2020 and 2021. We saw it with some of our international managers that were on the platform, had these huge mega years in 2020, 2021, fantastic returns that have all been unwound this year. And it's because they were just riding the beta train, and they were riding these booms that we had in certain kinds of asset classes. And I always ask the question, okay, if that's the kind of exposure that they're giving us, is there a way that we can get it cheaper? And that's what's been exciting about the blossoming of the ETF world, which is that we can essentially express active views through factor ETFs or specifically focused ETFs that now have enough liquidity that it's safe for us to be invested in them. Early on with a lot of these products, they were too small and didn't have the liquidity needed. So for a firm our size, we couldn't really use them in an efficient way. But now what we're able to say is, we actually just went through this process. We said, okay, some of our managers that we have in certain portfolios, high fee, not tax efficient, mostly in a year like this where we've seen outflows, we're likely to get, cap gains distributions at the end of the year. Can we replicate some exposure through factor ETFs? Can we get at the same kind of return profile? And where we could, we said yes, and we've cut our fees down by 2/3 and minimized the tax impact that we're going to have at the end of the year with a much more tax efficient structure. And it's interesting because that requires communication to your clients to say, look, like we're still making active calls. We're identifying factors that we think are going to do well in this market environment. But we're doing it in just a much more efficient way. There's still a taboo around ETFs that you're just indexing and, what are you adding in value? But mostly for small accounts, if you're investing accounts that are much smaller than, maybe it's a side account or retirement account for a client, using these very efficient ways to get exposure in a fully allocated portfolio can be very powerful for the client, because it's just much more of an efficient way to get that exposure in a lower fee way. And like we said, after facts, after fee returns really do matter.
Sure. And in terms of the factors you're looking at, is that kind of risk premium, or what types of strategies are you thinking when you're talking about factor ETFs?
Yeah, so we're looking at whether it's dividend, quality, size, momentum, value, growth, all your typical kind of like all your typical factors, and identifying when we think each of those factors might have periods of better performance or not.
And in terms of kind of quant strategies, that the types of things that we talk a lot about on this podcast in terms of trend following, which is kind of cross-sectional momentum, managed futures or global macro strategies, are they the types of strategies, are they suitable for the clients given their kind of tax considerations, or can they fit in these types of portfolios?
Yeah, that's where we have to be very conscious of tax, because a lot of these kinds of portfolios or strategies can throw off quite a bit of tax distributions, which we are very sensitive to. But for a lot of clients, it as long as they do what they say they're going to do, and that is probably the most important kind of bottoms up analysis that we do in identifying these managers, is a very high say do ratio. Because if you're going to pay fees and have some kind of lockup in expectation that it's going to interact with your portfolio a certain way, then you better be getting that kind of interaction. And so we keep I would say a short leash and do a lot of due diligence on those. And like I said, they can be very powerful parts of portfolios from a volatility dampening approach, and you're not giving up too much on the return upside. What we just have to be aware of is the after tax impact. At the same time, is that if you are a very long-term investor, having lower volatility in your portfolio on a year-by-year basis at the same time of having that lower correlation, it may not actually be as valuable to you if you're not going to use those assets at all, if you don't need the liquidity. So we kind of balance those decisions. But so for our clients that will need the liquidity and need that kind of offsetting exposure, it's a really powerful way to get that portfolio volatility down and not have to give up too much on the return side of things.
Absolutely. And I'm curious as well. I mean, you talked about the Nifty 50 example from the 1970s, and I guess that's an example of a set of stocks that were hyped up, you might say, or there was a very interesting, compelling narrative around it. I mean, obviously, you're dealing with individual investors as well. Do you find that that's a challenge, that people can get seduced by the narratives around these stocks and the various themes in markets? And how do you kind of help individual clients navigate that and keep focused on the true fundamentals?
Yeah, that it always, you don't want to rain on clients' parades, but I don't know if it's best practice to use clients as contrarian indicators, but I mean, oftentimes they can be, but at the same time, look, you've had a periods of incredible performance of certain stocks that have defied the odds of the smartest guys in the room over the last couple of years. One of the arguments, and this gets back to our discussions about valuation and liquidity. I've been making the argument really for the past it started in the summer 2021, which is that liquidity matters more than narrative. And this also gets back to where your returns are coming from and actually understanding the source of your returns. And that's so important, mostly when you're dealing with these kinds of stocks that can be very alluring, that come with stories attached to them, that come with narratives. If we look at the relative performance of something like ARK versus the market, so that kind of prototypical high growth narrative kind of asset, or IPOs versus the market, or crypto versus the market, even. The peak in relative performance happened in March of 2021 within a peak in the M2 money supply growth. This has never been about changing the world with technology. This has always been about liquidity. And there's wonderful narratives that can go along when you have these big rallies up, and then, wonderful narratives on the way down when you're fighting the world. But the reality is that you have to know the source of your returns. And I went through this battle when I was covering the industrials, and I would love to retire the word thematic, because it's very misleading. People misconstrue the word thematic. They mix it up with thinking it's secular. Secular implies a trend that is much more impervious to cycles, right? So you have compounding growth over the long run, and it's a very long-term trend. And so what happens is people buy things that are thematic, thinking that they're going to be able to just buy it, forget it, and hold it forever because this trend is so powerful, this theme is so powerful, just like the Nifty 50. When in reality, a lot of these thematic names are either just bursts of momentum, meaning that you can get exposure to them by just having a momentum ETF, or they are just added beta on top of some other trend. So here's the example. Robotics. Robotics was the go-to theme in 2016, 2017. Because we were going to replace all the humans, labor was expensive, and so everybody bought into this theme of robotics. The challenge is that if you look at the relative performance of the robotics ETF, meaning when it's outperforming, when it's underperforming, it is the same darn chart as the US PMI. Meaning that if you are in a manufacturing deceleration, you're going to underperform huge if you own the robotics sector. So the fact that it's an alluring theme and it comes with a great narrative does not mean that you can ignore the cycle. And so when we think about wanting to invest portfolios for the long run, it's so easy for people to say like, oh, I'm just going to buy the things that I think are going to be big in the out years. And that can work if you are never going to look at that portfolio, maybe, because a lot of these themes haven't materialized, whether it's things like, investing in water scarcity, for example. It's been a popular theme for a decade and good luck making money. But the point is we have to be aware of where we are in the cycles and we have to be conscious of where these returns come from. Is it because of liquidity? Is it because of the manufacturing cycle and beta to that? Is it because of momentum? And if you have that approach, then I think you're far better suited to invest in long-run things and have a long-run perspective, because then you can avoid the fatal flaw of buying at the top and selling at the bottom.
Great. Thanks for that. We're over an hour now, so I'm just conscious of time. We normally kind of wrap up by kind of reflecting on our guests' careers and advice to have. And I guess one thing that stands out, you mentioned at the start, you trained as a ballet dancer when you were younger. So I'm curious to know how that set you up for a career in finance, investing, or when you look back, was there things you benefited from that training that stand to you now as an investor and a CIO?
Yeah, I think there's lots of things. I think the first one, because I homeschooled myself online, it made me a little bit more autodidactic, self-learning, self-teaching, which I think is really important in the finance realm, mostly if you're launching new coverage on anything. And I think that's what I enjoy so much about this industry, which is that you never know everything and there's always something new to learn and get up to speed on. And I think that's the coolest thing about working in this field, is that there's always something new to sink your teeth into. And I think that love of learning and discovering new things kind of on my own helped very much, with the CFA studies and now in kind of being a core research analyst kind of in my bones. The other one is that things like the CFA are easy in comparison when when you're used to doing 12 hours of rehearsals a day and having shoes thrown at you. Okay. So, so it's that discipline certainly helps. And I think the last one is just having a bit of a different perspective. I mean, I always thought I was going to be an artist of some sort. And for a long time, getting really deep into being a fundamental research analyst, I kind of had to put that pursuit on the back burner. But I think now in my role where I get to do things like this and speak with you and speak to other people in the field in different mediums, it's like everything has come full circle, which is just the absolute coolest. I pinch myself. I think I have the coolest job in the world. And so to be able to be an analyst and have a performative kind of outlet that always has been my itch because of being a dancer and all these things is really fun. And I like that I have a different background. I think that's helpful from an analytical standpoint. You kind of, you hope that you can look at the world a little bit differently at times. Though occasionally you find yourself in consensus.
Yeah, and you can't be contrarian all the time. Taking that a step further, then not everybody is going to start off training as a ballet dancer and self-schooling. But what would you say as advice to aspiring CIOs, in terms of things to do or interesting things to read or anything that's particularly influenced you from that perspective in the course of your career?
Oh, yes. I should put together a companion book list of some of my favorite reads. I mean, I think of books like Mark Blythe's Austerity, Steve Rasciuto's Disequilibrium. There was, I think it was Sebastian Mallaby, The More Money Than God, The Smartest Guys in the Room, the one about Enron. There's tons of books that have been so important and informative, and I try to be as much of a voracious reader as I can be. Then, the other piece of advice, and this is something that I give to a lot of the young women that I coach, but I think it's applicable for everybody, is that sometimes it's in our nature to want to seek out situations and opportunities where we are like everybody else, meaning we might look like them or have similar backgrounds to them. But maybe it's because I found myself as one of only 2 women that covered industrials, and I'd sit in a room and it'd be 40 dudes and me. I found that there was great power and opportunity in seeking out areas where you are different, because if you can combine being different, having a different background with a certain level of aptitude, where you are additive to that conversation, that environment, the whole thing, I think it's like swimming downstream. And I would encourage mostly, like I said, is the young women that I coach and speak to, is, when it comes to choosing what you want to cover in your research analysis, don't cover handbags. Cover utility stocks, cover like oil and gas stocks, cover something that people don't expect you to do, and you have a far greater likelihood of carving out a niche for yourself and finding yourself in scenarios where you can stand out. And I think standing out is important, mostly if you're going in these, trying to go for these larger roles, because you have to have a different voice, you have to have something to say. So I find it invigorating every time I see myself as I look around and I'm like, oh, I'm something. One of these doesn't belong. And I think it's just darn fun. And occasionally it's frustrating, but for the most part, I've just had. It also helps that I've also worked with great people, and all through my career, I've had people take me under their wing and show me the ropes and be supportive and helpful. And so that helps a lot. So work for good people and be nice.
Great stuff. Well, that's interesting and wise advice, I think. It's been great having you on. We've gone well over an hour. So thank you very much for taking the time to join us today. And with that, I'll hand it back to Niels.
Thank you so much, Alan and Cameron, for a super fun conversation full of energy and where you managed to cover a lot of ground. There are many things that stood out to me, not least the amazing career path that Cameron has taken. And I fully agree that doing things differently can help you think outside the box, which is very important in our line of business. I found Cameron's observations about the usefulness or lack thereof of correlations quite interesting, as well as her thoughts on the importance of knowing where you are in the liquidity cycle and how this really drives valuations. Also, Cameron's 3 reasons why you would want to pay more than 20 times earnings was very interesting to me. And maybe to round things off, I love the question that Cameron believes the Fed should ask themselves and how this answer will dominate the future path of interest rates. But of course, there are so many more gems in this conversation. That's it for this episode. Make sure you go and follow Cameron and Alan's work because, as you can tell from today's conversation, it is so important that you understand what's going on from a global macro point of view in order to allocate capital well. And we really look forward to sharing many more of these insights in our series as it continues. From Alan and me, thanks so much for listening, and we look forward to being back with you on the next episode. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.